This week, Standard & Poor's made it official. The big US banks are not too big to fail. The credit rating agency has taken 8 of the biggest banks down by 1 notch, judging that regulators have made enough progress on a new resolution regime that if we get another Lehman-like crisis, some of them may make it and some of them may not. But the failure of any one of them won't bring down the system, forcing the taxpayer to come to the rescue. The decision was prompted by new rules on TLAC, or total loss absorbing capacity. This is basically jargon for debt that can be converted to equity, once all the existing equity has been wiped out by losses on assets. Core equity levels have already been pumped up since the crisis. But within the next few years, the biggest banks will be forced to hold a big buffer of this special debt on top. Regulators expect that the debt will act as a sort of emergency shot of adrenaline, allowing a bust bank to keep doing business as it winds itself down in an orderly fashion. Next year, the US Federal Reserve will clarify exactly what kind of long-term debt will qualify as TLAC. But for now, S&P is satisfied that the likelihood of government support has faded. Hence the downgrade for the Big 8. The big banks are still very big, most of them bigger in fact since the crisis. But the next time the system starts to wobble, there'll be a private bail-in rather than a public bailout. That's the theory at least.